Sales are certainly robust. If MasterCard is right, 5.1% is the best holiday season in 6 years. But the tail of the tape waits until February when gross margins and expenses get tallied. And we've already seen a whole host of warnings coming out of third quarter about pressure on gross margins and expense, largely driven by the degree of discounting and the expense of shifting to e-commerce. So I think we ought to hold off on pulling out those corks for another couple of weeks.
Do you disagree, Simeon?
You got a pair of Grinches here, sorry guys. But I think that, and Mark and I were talking about this, at the group of companies that we look at had the best sales growth in years, but it also had the most SG&A growth, the most expense in years. That's not going to stop. And then what was really interesting, the expectations that people have, that investors have for the following year came down the most in years. So what that means is we have the sentiment versus fundamental conversation, which we always talk about, that people had embraced this idea that retail was back with a vengeance. For the past 9 months, retail was the best sector you could imagine being a part of, which was ironic because it had apparently died right beforehand. So it feels like right now figuring out where we're going to normalize, right? We went too far to the negative, we're probably going too far to the positive. The sales will be there. The question is going to be, what do they cost to get?
So you guys are saying this was a profitless sales boom that we're seeing at retail?
So I think right now, this quarter, right now you still have some gross margin. We've spoken about the idea that there's more inventory on the floor than people might appreciate. When there's inventory on the floor, you're forced to discount. And I think that that's going to happen go forward. So right now you've been spending on the expense side, and we've seen different pieces, freight, labor, right? There's different components that in theory can be good things for the environment, but bad for the specific retail. I think next year is where the year where we find gross margin become a little bit more challenging.
On inventory, I remember asking Gannett this on Black Friday, whether or not people pulled forward to get ahead of tariffs and that ended up in a bloated promotional environment, more so than necessary. Did that happen or is it something else?
I'm sure it did. It had to happen. If you've got commitments overseas on goods that are likely to cost more money, 10, 15, 20, 25%, you've got to be crazy not to bring them forward, just from a pure economic point of view. Of course, there's a tremendous price you pay for logistics and all of that. But the biggest issue is not just bringing inventories forward, it's not knowing where these tariffs are going or if these tariffs are going. So I think that there's a consequential threat to retail, which is the shift to e-commerce, which creates an enormous number of distortions down to the P&L. And then there's this existential threat, which is the specter of these broad-based tariffs, which could drive an enormous array of consumer goods up substantially starting in early second quarter.
Simeon, you described this sort of pendulum swinging, right? From people being too dark, then too optimistic, now swinging back. What kind of companies are best positioned for wherever this settles out right now? Who's spending the smartest if, in fact, everyone has to spend more?
So, generally speaking, the brands are going to have power. So I would say the sequence of events in Stockland was multinational brands that would have to deal with tariffs, would have to deal with global uncertainty and demand, took a massive multiple beating earlier on. Department stores, US-centric, complacency, I would argue, around the domestic level of comfort came later. So in the past month, we've seen that catch back up to itself, and you've seen the US-based names take a hit. I would argue that it's the multinationals looking into next year that are going to be better equipped, because as everyone has to deal with the same issues, I think that we probably got a little too comfortable on the US, a little too afraid on the global.
Like who?
So I would say at the end of the day, we think that Michael Kors, Tapestry are companies that are trading at meaningful multiple discounts to where they were. I think the reality is Nike took a nice wash over the course of the past month. You saw a little bit of a rise when they put up what looked like a flawless quarter. And then because the market is what it is, we saw it fade back in. So I think the interesting here is you take the brands, but then on the flip side, we're dealing with department stores that are trying to figure out what their existential reason for being is. And we have this discrepancy where the off-pricers, which have kind of gotten a little quiet, even though TJ, Ross, Burlington, these were the companies that were the most touted names for a while, that discrepancy will continue. When we hear about stores and brick and mortar doing well, that's them.
Mark, would you stay away from your old department stores?
The department store genre is dead. Whether they have a heartbeat for the next year or two remains to be seen. Certainly Sears is gone. I think Penny's is going to be circling the drain.
They're figuring out the online business. They're figuring out how to make their stores more of an experience, aren't they?
Well, they say they are, but if you visit their store, certainly if you visit their stores outside of for example, Herald Square. You don't see much evidence of that. They're going to tout this enormous increase in e-commerce business. Of course, they're not rigged for that business. I want to point something out. When a customer shows up on December 26th with an ugly sweater and looks to return it, a good percentage of those customers will swap that out for something they'd rather have. But when a customer returns something they've bought online, that's it. It goes into a black hole, and the retailer has no recourse except to liquidate the goods somehow. So this shift into e-commerce isn't working very well for the department stores because they haven't reset their real estate portfolios fast enough to accommodate what's going on. A 20% increase in e-commerce, if MasterCard is right, is a massive shift, once again, toward a channel that didn't exist essentially 10, 15 years ago.